This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Documenting Charitable Contributions, Part 3, Property Gifts. This is Professor Russell James. The smallest gifts of property, under $250, require donor records to answer the questions of who made the gift, what was the gift, when was the gift made, where was the transfer made, and how was the gift valued. Except where it is impractical, these donor records must include a receipt from the charity indicating what was given, when, where, and by whom. So for gifts of property under $250, the donor must have a receipt from the charity indicating the donor, the date, the location, and the description of the property, except where obtaining such a note is impractical. The donor's own records should indicate these things as well, although these records may include the charity's receipt. However, in addition, the donor must have reliable records proving the fair market value of the property, and if relevant, also proving the donor's basis in the property. Note that the charity is never expected to provide a valuation of the property. Although some charities may choose to include this in a receipt, such valuation has no legal effect. The charity is not qualified to give an appraisal. For small property gifts under $250, an exception is made to the requirement of a receipt from the charity when such a receipt is impractical. A typical example of a scenario in which such a receipt is impractical is where the donor gives clothing or property to an unattended drop box. In such cases, no receipt is required from the charity. However, even when a receipt from the charity is not required, the donor must still provide reliable records documenting the gift, the charity receiving the gift, the date of the gift, the place of the gift, and the fair market value and cost basis when relevant of the property. For gifts of property worth between $250 and $500, documentation must answer all of the potential questions: who, what, when, where, how, and why. In addition to the documentation required for smaller gifts of property, the donor now must provide a statement from the charity, and there is no exception for impracticability. This statement must not only answer the basic questions, who, what, when, where, but must also answer the quid pro quo question, in other words, why. Thus, for gifts of property of $250 or more, the donor must have both a receipt from the charity indicating the donor, the date, the location, and a description of the property, along with the phrase, "No goods or services were provided in exchange for these gifts," as well as the donor's own reliable records indicating the fair market value of the property, and cost basis if relevant. For gifts over $500, all of the previous documentation is required in addition to filing of IRS Form 8283. If the charity sells the item within 3 years of the gift, the charity must file IRS Form 8282. However, this second filing is not required prior to the donor taking the charitable deduction. The IRS Form 8283 filing is required for all property gifts valued at $500 or more. Note that for property gifts of $500 or more, all potential documentation items are required, excepting only a qualified appraisal, which is a requirement limited to gifts of specific types and amounts of property. An additional IRS form is required for gifts of property over $500 if the gift was an automobile, boat, or plane. Specifically, these gifts require the filing of IRS Form 1098-C by the charity. Form 1098-C must come from the charity within 30 days of the gift or the sale. Gifts of automobiles, boats, or planes that are intended to be sold by the charity cannot be valued for tax deduction purposes until after the charity has sold the item. This is because the deduction is limited to the amount the charity receives for the item in the subsequent sale. If, however, the charity intends not to sell the item, but to make use of it in its charitable purposes, then the charity may verify this intent by filing Form 1098-C within 30 days of receiving the gift. In such cases, the valuation need not wait for the sale of the item. Finally, with gifts of property of $5,000 or more, the donor must also obtain a qualified appraisal and must include a summary of the qualified appraisal in his or her tax return on Form 8283. This qualified appraisal is not required for publicly traded securities. Publicly traded securities are very easy to value, and there's relatively little dispute about their valuation at any one point in time because they can be immediately bought or sold at publicly available prices. Thus, for gifts of property of $5,000 or more, all of this documentation is required. A charity receipt with gift date, location and description, and quid pro quo statement, donor records of gift, charity, date, location, fair market value, and basis if relevant, and IRS Form 8283, including a summary of a qualified appraisal. If any item is absent, no deduction is allowed. The highest level of documentation is reserved for gifts of property over $500,000 or gifts of artwork over $20,000. As before, publicly traded securities are exempted from the appraisal requirement because their valuation is relatively simple. Note that these are the gifts with the greatest potential for abuse. Gifts of property over $500,000 may be subject to a variety of interpretations of fair market value. And given their value, such differences of opinion can have a dramatic difference on the payment of taxes. Thus, these large gifts warrant the most careful scrutiny by the IRS. Because these types of gifts will be subject to the highest level of scrutiny, it makes sense that the entire qualified appraisal must be included with the tax return. Not only are very large property gifts included, over $500,000, in this highest documentation level, but even moderately sized gifts of art are also included, that is, over $20,000. This reflects the challenges in the valuation of artwork and the consequent opportunities for abuse. Remember that for some taxpayers, combining both state and federal income taxes can make deductions worth 50 cents on the dollar. Thus, if a valuation were made that was more than twice what the donor could actually sell the property for, it becomes more profitable to give rather than sell the property. This potential for overvaluation is much more likely with property such as artwork, where intrinsic value is difficult to define. As a reminder, appraisals are not required for gifts of publicly traded securities, regardless of the size of the gift. Thus, a donor could deduct a $10 million gift of Microsoft shares with no appraisal. There are de minimis exceptions to the normal rules for quid pro quo gifts. A quid pro quo gift is one where the donor makes a gift but also receives something of value in return for the gift. Typically, these scenarios require both that the charity report the value of the item given to the donor and also that the donor reduce his or her deduction by the value of the item received from the charity. Although the charity is not a qualified appraiser, it is required to make a, quote, good faith estimate of the value of the item. IRS regulations indicate the organization may use any reasonable methodology in making a good faith estimate, provided it applies the methodology in good faith. However, if the gift was $75 or less, the charity is not required to report the quid pro quo part of the transaction. In other words, they do not have to report the cost or value of the item given to the donor. The rule applies only to the charity's reporting requirement. The donor must still reduce his or her deduction by the value of the item received in exchange for the gift. The donor can ignore the value of the item received by the charity in exchange for the gift only when one of two de minimis exceptions applies to the donor. First, the donor can ignore the value of the item received in exchange for the donation if its value does not exceed 2% of the value of the donation. This exception does not apply to items received that are worth more than $106. Note that this $106 level is a 2016 inflation-adjusted number that changes every year. Second, the donor need not consider the value of the item received in exchange for a gift if the cost of the item to the charity was equal to or less than $10.60, so long as the gift made in order to receive the item was at least $53. As before, these are 2016 numbers that are adjusted annually for inflation. These de minimis rules are intended to reduce reporting hassles for items of an inconsequential amount. Although admittedly among some of the least interesting rules related to charitable gift planning, these documentation rules are nonetheless important. The penalties for violating the rules can be severe, and typically there is no opportunity to correct documentation errors after a deduction has been erroneously taken. This has been Documenting Charitable Contributions. Thanks for joining us.